the most effective use out of Paycheck Protection Loans. I want to, I'll mention, because some of you may have seen this in the news. If Tim, if you want to advance a couple of slides, or actually maybe if you want to talk about just.
Yeah, actually, Ivan, I was going to hope everybody is hanging in there and healthy, and your families are healthy. I hope everything is going as good as it can be. I know everything is up in the air and changing rapidly and all the time, so it's a lot to digest. But I trust everybody is doing well. I'm Tim Linville. If you don't know me, I think I know most of you. With me today on the phone as presenters, I have John Forbes and I have Ivan Goldman. Ivan is an attorney at Hahn Lozier, and John is an accountant with H&W. And both of them have been working very intensely on the PPP Paycheck Protection Program loans, and are knowledgeable about that. Ivan has been consulting clients. John has been talking with some of our members, 30-minute sessions with some of our members regarding how they should spend these PPP loans. So with that, I'm going to turn the floor over to Ivan and John. Thank you, gentlemen, for being here, and the floor is yours.
Well, thanks, Tim. Thanks for having us, and delighted to have the opportunity to talk to you and your members, and to take any questions that people have. As I was starting to say a moment ago, I think this presentation is largely geared toward businesses that have already received, or at least have an application in the pipeline for a PPP loan. You may have seen just yesterday, in fact, that Congress has voted to authorize an additional $310 billion for this program. The initial allocation was $349 billion, and that was subscribed for almost immediately. It was gone within 2 weeks. We have an additional, it appears that even that is going to, is going to be spoken for soon. I saw an article yesterday with one of the, I think it was like a bank lobbying group, or a bank professional organization. Most of these loans have already been accounted for, actually, by what's piped currently. Tim, are you able to advance a couple of slides? We go to the next one. We go next. Okay, so this is what I was talking about. And it's been an additional appropriation to the fund. Of the $310 billion, $60 billion was specifically set aside for small lenders, community banks, and credit unions. None of the substantive rules of the program that I'm about to talk about have changed. Although, as we will talk about a little bit, there have been some rules issued even as recently as the past couple of hours. So if you want to go to the first section of the program, it should be entitled Allowable Uses of Funds. I think it's probably slide, let's go one more. And yes, how can PPP loan funds be used? So let's advance to the next slide. So PPP loan funds can be used for only a handful of things. And as we're going to see, these are similar to, but slightly different from the amounts that are eligible for forgiveness. So in general, loan funds can be used for payroll costs. They can be used to pay rent. They can be used to pay interest, mortgage interest for businesses that own their premises or have mortgages on personal property. They can be used for utilities. They can be used for interest payments on other debt that was incurred before February 15th, and they can be used to refinance an economic injury disaster loan that was issued between January 31 and April 3rd of this year. There was some misconception, especially early on, about whether borrowers could have both an EIDL and a PPP loan. And the answer, yes, you cannot have an EIDL and a PPP for the same purpose. So if you borrowed money through the Economic Injury Disaster Loan Program to pay payroll costs, then you must refinance that loan into your PPP loan. Next slide, please. The actual text of the legislation suggests that PPP loan proceeds could be used for other purposes, or even could be used. I've heard some people suggest that, well, if we're concerned about forgiveness, perhaps we could use this for anything. We could pay down principal on other loans or what have you. And the answer to that from the SBA is no. These loans are only for specified purposes, separate and apart from forgiveness issues. So next slide, please. There's an additional rule that, of the amounts that, of the amount that you receive, at least 75% must be used for payroll costs. And so, to put it another way, no more than 25% can be used for other items I talked about, like, payment of rent, payment of mortgage interest, payment of utilities, and so forth. Next slide, please. Borrowers are subject to penalties for a knowing misuse of PPP funds. This, is a concern for some borrowers, particularly given, how much confusion and how much gray area there is around what are some of the permissible uses of the loan funds. And then some of you may have seen, over the past few days, there have been a few articles in the newspapers and so on talking about, larger businesses, even a handful of publicly traded companies that were able to, essentially find loopholes to apply for and receive these loans, which are, intended really for small and medium-sized companies with 500 or fewer employees. And there was a lot of, outrage about that. And so just yesterday, the SBA announced in an FAQ on its website that certain, well-capitalized businesses, they give the example in particular of publicly traded companies that have access to, capital markets, generally are not going to be eligible for these loans. And sort of the technical reason for that would be the loans require you to certify as a borrower that it is necessary to maintain ongoing operations. And the SBA essentially said that if you have access to, other capital, if you have a billionaire founder or other circumstances like that, where you have other ready sources of funds, you really can't give that certification that this is necessary to maintain operations.
Ivan, is that certification? Ivan, is that certification new, or has that always been the case?
The certification has been part of the loan application from the outset, and I think people have had questions about it. I know I've fielded some questions from people who said, well, we're not sure if we're really going to need this loan. And I think because of the uncertainty, and because there was no sort of explicit requirement that you had to have no other source of capital or other source of funding, most people said, well, you ought to err on the side of getting it. And there's so much uncertainty right now. Who's to say what businesses will and will not be affected? So it's not new. It's more of a refinement of sort of the existing rule.
All right. There's a question that there's a question we've gotten regarding forgiveness of the loan and for tracking. For our union employers, like our employers, the question is, are they able to include the fringe benefits that they pay into the union as part of the payroll cost? They pay for funds such as vacation funds, healthcare benefit funds, and things like that. And the question is, since those are listed in their obligations to pay their employees, their union employees, are these qualifying or forgivable payroll expenses?
That is an area that I think there continues to be some uncertainty about. My inclination, and I would be the first to admit that I may be wrong, but my inclination would be that as long as those amounts are actually incurred, meaning they have an obligation to the union or to the employee to pay that amount, and as long as it's actually paid during the 8-week period that begins on the date they get the loan, I would think that is an includable payroll cost.
Yeah, I would think so too. And I know that some of these expenses are paycheck deductions, which that is part of the employee's wage, so that's included.
That's correct, and that's sort of the one thing where, in a way, it seems obvious, but the way the statute is written, there have been questions about it. There does have to be. You can't double count. You can't count, for example, if an employee makes an elective, deduction for his or her retirement, you can't count that as both wages and as a retirement contribution. But you're right. Anything that the employer is paying that's sort of over and above wages, whether it's a match to a 401k or whether it's a contribution to the employee's health care, that should still count as a payroll cost to the employer.
Right.
Okay. Why don't we go to the next slide? Okay, how much of my loan is eligible for forgiveness? So I said a moment ago that the forgiveness amount ideally is the same as the loan amount, but that's not always the case. So I'm going to walk through next what is eligible for forgiveness. Let's go to the next slide. So in theory, if you do everything right up to the entire principal amount and all accrued interest is eligible for forgiveness, and the statute specifies that forgiveness amount is excluded from gross income. So whereas the typical rule is that if a borrower has a debt forgiven, there's cancellation of debt income to the borrower. In this case, there is no such income. So it truly is free money to borrowers. And again, the actual amount of the forgiveness is going to depend on how much the borrower is able to spend during that, what I'm going to refer to as the covered period, which is the period, it's an 8-week period that starts on the day that the loan is disbursed. Let's go to the next slide. So payments made during the covered period are going to be eligible for forgiveness. Payroll costs. Here, payroll cost has the exact same definition as it had earlier, and as we talked about a little bit. It's basically cash payments to employees, as well as some of the non-cash items like contributions to retirement plans or for insurance premiums and so on. It also includes payment of mortgage interest, rent payments, and utility payments. In each case, however, it's for obligations that were incurred or entered into before February 15th, 2020. Next slide, please. So that is a somewhat, you can go back. So that's a somewhat narrower list than what you can use loan proceeds on in the first place. So, maybe the simplest example would be you get a PPP loan and you have a lease that you entered into on March 1st. You can use your loan funds to pay rent under that lease, but that use of funds is not going to be forgivable. And just as we saw with overall use of proceeds, at least 75% of the forgiveness amount has to consist of payroll costs or again, to put it another way, not more than 25% can consist of rent, interest, and utilities. So let's advance a couple of slides, actually. So I'm going to talk for a few minutes. There's an idea out there, and I think at this time, a lot of people hopefully are starting to see some of the nuance, but there was this idea that I was hearing for a while about if my company had to lay off employees or to cut salaries, that I would not be eligible for loan forgiveness. Here's the way that actually works. It's a bit technical, but let me try to walk through it. Go to the next slide, please. Tim, are you able to advance the slide?
Yeah, sorry
Thank
about
you.
that.
Yeah, no problem, no problem. So the forgiveness amount generally is going to be reduced by multiplying it by a fraction. The numerator of the fraction is the average number of full-time equivalent employees employed by the borrower during the covered period. And the denominator is going to be one of, I say here, the lesser of. I mean, technically it's the borrower's option, although you would always want to choose whichever one is going to be less. But it's either the average number of full-time equivalent employees between February 15 and June 30 of last year, or the borrower's average number of FTE employees during the first 2 months of this year. So for example, if the borrower has 90 full-time equivalent employees during that 8-week covered period, and they had 100 during the testing period, their forgiveness amount is going to be 90% of what it would otherwise be, or will be reduced by 10%. So if you otherwise would qualify for forgiveness of $1 million, if you had a reduction in your FTE, here you would qualify for forgiveness of $900,000. So next slide, please.
Yeah, Ivan, we have a question regarding rent. And the question is rent forgivable, or are only certain types of rent or lease expenses forgivable?
To the best of my knowledge, we don't have a whole lot of guidance on that. The statute just says, rent expense, or more specifically, I think it says, rent under a lease entered into before February 15th. I've seen some questions about, where rent is broken out as, common area maintenance and rent, and then even tax sometimes if it's a triple net lease. My assumption, and it's again a little bit of speculation because there are still so many gray areas, but my assumption is that the full rent amount is eligible for both for use and for forgiveness.
And then do you have any knowledge what kinds of transportation expenses would be forgivable?
I don't, and it's funny you should mention that, because so the statute defines utilities as payment for a service for the distribution of, and then they list certain things that some of them are obvious, water, electricity, gas, telephone, internet access, and they have transportation in there. And I will confess, I don't know what it means. I'd be interested if anybody who's participating today might have an idea what it means, because that's one definitely not make a lot of sense to me.
Got it. Okay.
So if you want to go to the next slide. So I mentioned this, the forgiveness amount being reduced if there's been a reduction in full-time employees. There's also a reduction, and this one is not a percentage, but rather it's an amount, and it applies when you have reduced salaries of employees who earned $100,000 or less during 2019, to the extent that you've reduced their salaries by more than 25%. So, for example, you had an employee who earned exactly $100,000 in 2019. you reduce their salary by 40%, and so the borrower's forgiveness amount would be reduced by, it's actually, and I apologize, I think there's actually a slight mistake on the slide. The forgiveness amount is reduced by the amount by which their reduction in salary exceeds 25% relative to last year, but it would only be for the covered period. So instead of like here, I'm saying 40,000 minus 25,000, that would only be, you would apply that to the covered period. So it would be whatever, 850 seconds of that is. So it's maybe a couple of $1,000s, a few $1,000s. So it's not generally a significant reduction, but the idea here is that you're not going to qualify for full loan forgiveness if you are reducing the salaries of low and moderate income workers by too significant an amount. And then there's an exception to the exception, which is that if you have your, if you had either a reduction in force or a reduction in employees' salaries, by more than 25%, that occurred between February 15th and April 26th, and then you eliminate that reduction before or on or before June 30, then you will not have your loan forgiveness amount automatically reduced. The reason I specify automatically is that if you think about the math, you may still have an issue, getting to the full amount of payroll that is needed to achieve full forgiveness. So if you had, to take an extreme example, if you had, a lot of full-time equivalent employees, and your average payroll amount is based on that, and then you do, a huge number of layoffs, you have very few people working during the covered period, and then you bring them all back on June 30, technically you might not have an automatic reduction, but the payroll that you paid during the covered period is not going to be anywhere close to your loan amount because you just had so few people working and earning so little in salary. Does that make sense to people?
That makes sense.
I guess everybody's,
so
I guess everyone's muted, but hopefully it's
everybody's muted. There are comments, Ivan and John, if you haven't seen them, comments in the chat function of the technology that you might want to look at. Nothing pending right now, I don't think. But on this slide, you said there may be a typo on this slide. Where was that at?
Yeah, so if you look at the middle slide, or the middle bullet point, I said that the forgiveness amount would be reduced by 15,000. And I think, just the mistake there is that it's not, the reduction is based upon the covered period. So what I would have to figure out would be, what is that? It's basically, it's a $15,000 reduction for the year, but what does that look like if you took it just for the covered period? So if I think it would be basically, 850 seconds of 15,000. So you'd be looking at a reduction of just around 2,300, not 15,000. So. Okay, if we want to, actually, are there other questions before we move on?
I think that's it on this slide.
Okay. Okay, so then starting to get some just kind of, practical questions about how do I apply for loan forgiveness. John's going to talk in just a couple of minutes about some of the sort of practicalities of how you make sure you are, keeping track of all this information in a way that's going to be most helpful to you and most useful to your lender. But, essentially, at the end of the 8-week covered period, or very shortly thereafter, the borrower is going to submit an application to the lender that includes documentation that verifies the number of FTE employees that it had during the covered period. We know that it's going to include payroll tax filings. It's going to include, state income, payroll, and unemployment filings. And then they'll also have to include, proof of payment, proof they actually paid these amounts. So things like canceled checks, payment receipts, account transcripts or bank records or other things like that. Next slide, please. And then, like with most or probably every other loan, the borrower will have to submit, certification that the documents it's presenting are true and accurate. And this is the one that, maybe for certain employers now they have a little bit more heartburn over this one, but the amount for which forgiveness is requested was used to retain employees, make interest payments, uncovered mortgages, make payment, uncovered rent obligations, or make covered utility payments. So again, you have to certify that all funds were used only for covered purposes. And then if there's any other documentation that's required by the SBA administrator or the lender, I think it's possible that SBA will release sort of a standard form of application, but at least to my knowledge, they haven't released one yet. I know, for example, with respect to the actual note, most, if not all, lenders are using an SBA form of note. I don't know that they have a form yet for the forgiveness application, but it's possible that we'll see that.
What if you have a temporary employee from a staffing service?
That's a good question. I believe that is counted toward your employees, but I'm not certain about that. And I think it may depend on, some of the circumstances as to, who has the right to control the person, who is technically the employer, things like that. I know I had one question like that come up for a client a couple of weeks ago, and but it tends to be sort of very facts and circumstances. When a lender receives an application, they have to issue a decision within 60 days. I said earlier that a borrower would generally apply, for forgiveness at the end of the 8-week period. I don't know that there's technically a deadline for when to apply. However, for most borrowers, you would think that you'd want to apply as quickly as possible. Number one, so you know what your forgiveness amount is, and you know how much, if any, you're obligated to repay. And number two, just because you want to apply as quickly as possible so that you have all the records handy and things haven't been misplaced, and information and documents haven't gone missing. So as with a lot of things, it's in your interest to apply for forgiveness as soon as possible. Let's go to the next slide.
Sure, and I'm not sure what your next slide holds, but we have a couple of questions pending.
Sure.
One is, are costs considered based on the cash payment date or when the expense was incurred?
So we don't know. To a certainty about that. However, my assumption is, the statute says costs incurred and payments made during the covered period. So if you get your loan, let's say you get your loan today's a Friday, and let's say you have your next payroll is next Friday, and it covers a 2-week period, and so approximately half was incurred between today and next Friday, and the other half was incurred before. My assumption there would be that only about half that payroll is going to qualify as payroll costs and qualify for forgiveness, because it has to be both incurred and paid during the covered period. And likewise, I think that's a reason why I'm skeptical whether people can, prepay their rent or prepay their utilities or things like that. I think that while there isn't any guidance on that issue yet, and while I would expect to see it at some point because it's a question that everyone has, I think the intent of this program was to provide businesses with cash they need to continue operating during an acute crisis. And I don't think that, the SBA is intending to make loans so that people can, prepay their rent through the end of the year, things like that.
Right. The other question is maybe perhaps Ohio specific, but in Ohio, construction has been allowed to continue operating as an essential infrastructure industry. And so this kind of relates to the earlier discussion we had on the certification that the borrowers need to make that they actually need the money. But does the fact that construction has been allowed to continue, let's say you lost revenue, you lost maybe 25% of your revenue you were expecting during this crisis, how does that impact your situation as a contractor?
Yeah, I think, it depends. In the guidance that the Treasury or the SBA and the Treasury released yesterday, the only example they give is sort of, a large public company with access to, the public markets would not be eligible. I think, it might be a harder case for, smaller, medium-sized, privately held company. There is explicitly no requirement, with many forms of SBA loans, there's a requirement that the borrower, certify that it cannot get credit elsewhere. There's no such requirement here. However, if the facts are such that, the borrower is, flush with cash, they are in an industry where their clients or customers are continuing to pay, maybe they have one or more, wealthy founders who have cash, I think it's facts and circumstances, but certainly you could imagine a situation where, the SBA says, we don't believe that you had any need for this loan, and we don't believe that you were eligible. That being said, I don't expect them to take an especially strict stance with that, especially as it relates to, private companies. But I think you have to just look at the facts. Okay, and last couple of slides before I turn this over to John, who is going to talk more about, again, kind of the practicalities. What happens to any loan balance that is not forgiven? Well, generally anything that is not forgiven is it's a loan that has to be repaid over 2 years at 1% interest. There is an automatic 6-month deferral of all payments of interest and principal. So effectively, at the end of 6 months, you'll then have 18 months further in which to repay all of the principal.
You cut out there, Ivan. Would you repeat the last part?
Sure. The interest can accrue during the 6-month period of deferral, and then so once whatever balance remaining, if any, at the end of the period, you can defer for 6 months, and then effectively you'll have 18 months in which to repay interest and principal.
Okay. So John, is this your first slide?
Yeah, this is my portion of the presentation. First of all, I want to thank everybody. Thanks CEA and Tim for inviting us to speak. One thing that we've gotten out of what Ivan shared with us is that as quickly as this program was run out, the issues are not clear. Rather than the initialism of PPP, it should probably be TBD, because we're waiting for so many things to clarify, reporting and the like. And I'll cover some of those with the questions at the end that I've had the benefit of talking to several CEA members to get their concerns. And I'll address a couple of things that were brought up during Ivan's speech as they go through my presentation. The important thing to remember in all this is that the forgiveness is not guaranteed. You need to stay ahead of the game. You need to plan for the final reporting. Reporting is going to vary from bank to bank. They've got a minimum that I'm sure they're going to have to receive, but because of the bank's obligations, some banks are asking for more than others, and we found that with the application process itself. Some banks were taking a minimum to get their customers' names in and get their SBA account numbers set up. Others wanted all the information up front and never got into the application process. So with what I'm going to talk about now are some of the things that we think you should do. You don't have to do everything. The thought being the more you do, the better prepared you're going to be when we have the final reporting requirements out. And most important is going to be to track the funds as far as them being spent on the qualifying forgiveness items. Suggestion is to isolate fund disbursements through a single general ledger account. So in your accounting systems, to plan ahead. So when the funds are available and you are dispersing funds, that you have a general ledger system account set up in order to track those funds and to make the final reporting easier. Many advisors are suggesting, although it's not required, that a separate checking account be set up to park the funds in and make payments out of. Questions that come up in that instance would be payroll accounts, for example. Payroll services have accounts already set up, and we all know those can be a real headache to reset up. But if you just transfer the amount of each payroll into that same payroll account and just maintain the disbursements out of that account, but you're going to have the funds be transferred out of the forgiveness account, you can better monitor that payroll relative to the disbursement. Again, the account is not required, but in looking through the different other advisors that are proposing the process in order to gain the forgiveness of debt, the suggestion almost across the board is to maintain a separate account. Again, not required, but suggested. The account will be used for the 8-week period and actually can be used beyond that if funds aren't fully dispersed in that 8-week period qualifying. It's not written, but our opinion is that you still must maintain 75% payment of the funds on payroll related items, even if they aren't in the forgiveness side of the ledger. Tracking the non-payroll qualifying expenses. A question was asked earlier about rent and accrual versus cash basis. The actual law does not address cash versus accrual. As Ivan shared, and you'll see on the example in front of you, there are instances where payroll coming in may not be a reporting period prior to the funds receipt, but the payment would be after the funds receipt. On an accrual basis, that wouldn't qualify. On a cash basis, it would. Likewise, at the end of a pay period, if the funds are on the accrual basis, you could accrue a year-end, 8-week period end payroll, but on a cash basis, it wouldn't be available for you until after that 8-week period was up. So the suggestion is to, at the current point, track payroll and other expenditures on a cash and an accrual basis. Obviously, the direct wording of the regulations were they would be payments, which leads us to believe it'd be cash basis. I would think that the government is going to err on being fair, and as long as there's an equal amount of payrolls and rent and utilities going in and coming out, that I don't think there'll be a penalty relative to that. I also think that the banks who are policing this are going to be looking at this a little different until they have set guidelines. So it's important to remember that each bank can have different requirements over and above the minimums that are required. So it's very, very, very important to maintain the general ledger account. It's very important to maintain control of the disbursements themselves. So as these rules come out, the data is available. And remember, at the tail end, the banks are going to have 60 days to come to judgment as to what is forgiven and what isn't. And you can see how they were inundated with applications. They're going to be even more inundated when all of these forgiveness applications are put in to the bank, even more so. So they've got 60 days to do it, make it easier for them, it'll be easier on you, and you'll be able to maximize where you're at relative to the forgiven portion. Also important to remember that it could be difficult for a lot of people to disperse all of the payroll in the 8-week period when you consider 8 weeks alone over 2 months. 2 months is more than 8 weeks. There's going to be situations in which people can't spend the full amount of the money. So decisions have to be made at that point as to what they want to do. Tim, if you can go to the next slide. The full-time equivalents, I'm going to step back for 1 minute and then I'm going to go back to where we just left off. Full-time equivalents relative to the process, you should establish a base, the base being, as Ivan had indicated, and the bullet points there, you're looking at a period February 15th to June 30th of 19 or January of 2020 through February of 2020. Establishing that base to your advantage between those two periods, that you'll be able to maintain the full-time equivalents that you're needed in order to have the forgiveness of the loan. Now, one thing that's come up quite a bit in my discussions with CEA members, not everybody has contracts available to be worked on in that period. Decisions will have to be made as to whether it's beneficial to leave employees laid off because the work's not there, to bring employees back and have them not necessarily work if the work isn't there, maintaining the equivalence and maximizing the benefits to the company. Could be just to carry the loan forward as a 1% note, depending on how the numbers crunched relative to when work would be available, when it's not going to be available, what full-time equivalents are available, as well as what payroll is going to be maintained. So it's very important to manage these numbers going into the process, have a handle on the process and what each contractor's situation is relative to work available. Do they want to maintain certain employees and not give them up and pay them to do nothing? Or are they better off to lay them off, let them get the unemployment and use the loan as a low percentage, 1% 2-year loan? In situations where, and we talked about this a few minutes ago, in situations where payroll may not be sufficient to maintain the 75% requirement. Remember, there's two requirements. There's full-time equivalents and there's payroll requirements. Bonuses can be paid. Prepayments most likely would not be accepted, but bonuses are allowed. Now, paying certain employees bonuses and hoping they stick around the balance of the year is a business decision. So where you stand relative to the payroll based on what you've established as your base and monitoring that base every step of the way is going to be very, very important, which gets us back to the general ledger accounts, maintaining spreadsheets, which we're developing one right now. The spreadsheets will have to be flexible depending on the contractor and the type of business. So if anybody does have an interest in that spreadsheet and they'd like to work through that with me, we should have that available for next week, but I'd like to make sure I discuss it with them so they know how to utilize it properly.
John, one thing I've been hearing from several sources is that companies are extending out their payment terms. If they used to pay 30 days out, they may pay 60 days out. So would that be a strategic decision that contractors should be thinking about when considering whether or not to utilize the PPP loan that's not forgivable? Even if it's not forgivable, it might be a useful thing if you don't have a better alternative in terms of a line of credit.
Well, the PPP funds are supposed to, the whole process was put into place to ensure payroll. So what you spend the PPP funds versus spending them on items that would relieve cash for other areas is one way to work around it, but you have to maintain, in our opinion, 75% of the funds for payroll related and virus related issues. When the loan is put into place, when there's in the application, there's not a guarantee, but a sign off that the reason you're into these loans is because you were affected by the virus. The disaster loan was put into place to help on an operating side of things. The PPP loans were put in place for payroll side. So when you say defer expenses, are we deferring payroll? If we're deferring other expenses and utilizing PPP funds directly on that, that could be an issue relative to that guarantee up front.
Well, my question was sort of if the majority of your expense is payroll because you're a specialty contractor, you employ people to install on the job. If that's the majority of your expenses and the people who are paying you are extending the terms on which they pay you, you still have to cover your payroll expense.
Mm-hmm.
These funds might be beneficial to you even after June 30th if the person who's paying you is paying you later than usual. Yeah.
Now the disbursement, and again, it's a good question. The disbursement on the forgiven side obviously has to be in that 8-week period.
For the forgiveness, but not for the other part.
For the other piece, then it is prudent to utilize those funds to cover payroll costs later at a 1% rate. So if you can't what you can't cover in a forgiveness side, doesn't necessarily mean that the loan's not a benefit. It's a low interest rate loan, obviously, and the funds can be utilized over a 2-year period. And in some situations, we've talked to clients who have no interest in doing that, and they can pay the loan back. I mean, we have a 6-month deferral period. Interest is deferred. So there may be situations where what's not used in that 8-week period actually gets paid back to pay off the loan and get it off the book. So what you're saying is yes, it could be very beneficial to utilize those funds going forward, knowing that you're going to be giving up the forgiveness. But again, it's a 1% loan. It may be the only source of funds, especially for the smaller contractors. So it's one of the reasons we've told clients, in some cases, they don't know if they want to apply for the funds because they don't know if they're going to have the work. No one knows what's going to happen with this virus going forward. No one knows if there's going to be a backlash. No one knows what the economy is going to do. So applying for the loan with a legitimate application and deciding afterwards you don't want the loan is fine. You've got better information from which to make a decision relative to the loan and the fund availability. So yeah, it could and should be used from a payroll standpoint for those that have a hard time getting anything and utilizing their line of credit if they have no other ability to get a loan. So,
makes sense.
Yeah. If you can flip to the next slide. What I'd like to talk about is some of the questions that were raised by some of the CEA members that I've had the opportunity to talk to over the last couple of weeks. There were a couple of other questions that were raised that overlap with that. One being rent, for example, so that we don't forget. There was a question whether it was just rent or if it's rent payments on equipment and those kinds of things. The guidelines that we have right now say a valid lease in place and rent payments made. So the implication is if the lease was in place before February 15th and it's a valid lease, then it should qualify with the information we know now and what we're interpreting for forgiveness of debt. Also important to know that related party rent also qualifies if it's a valid lease that was in place before February 15th. So it's very important that where there is a related party rent, that it's been documented, that rental payments have been made. So in the forgiveness process at the tail end, if support is needed for that and it's challenged, that the data is available to provide to the bank. And again, we talked about the cash versus accrual issue. The same thing with utilities, the same thing with rent payments as payroll. I would go on a payment basis now, but I would also maintain those records in case we get some better information down the road. Important things to remember in the process before we get through some more specific questions has to do with the this last slide. If nothing else happens, I'd like people to take away from this to plan, plan, plan. Very important. You know, the hard part of getting the loan isn't where it ends. It gets even harder at the tail end to support the fact, if you're looking for forgiveness, that you've got the data available to support the funds were used properly, and they were used in that 8-week period that we've got after the fact, that you've maintained full-time equivalents, and that you have the documentation to support both. There are instances right now where some applicants who really didn't need the money have applied, and they're giving the money back because you start reading the small print where you shouldn't be taking money that wasn't necessary or required. You know, if you have a public company that has a stash of cash and they're doing well and they've applied for the loan, there could be issues with their maintaining that loan and having filed an accurate application up front, let alone using the funds for the proper purposes. So please maintain the records, please track the disbursements, please keep records of full-time equivalents, carry the documentation to cancel checks, the payment receipts, the transcripts, have the mortgage obligations, which could be building or personal or real property, covered lease payments, covered utility payments, maintain all the copies of all that information in order to support what was paid both in the 8-week period and outside out of these funds. I think there was also one question, I don't know that we responded to it. What happens if you end up with more employees than you went into the period? That's not an issue. You're only going to get forgiven the payroll that you applied for and you received. So the fact that you ended up with more employees than what you went in isn't going to be an issue relative to your application. The concern is going to be when you go below 75% below the full-time equivalents of 30 hours per work week. There was also a question regarding union benefits, health benefits, and retirement benefits. As Ivan said, it's another unknown. Part of the discussions we've had with companies across the country, actually, as well as local, they're taking the approach, and a lot of the banks have taken this approach, that the health care and retirement portion of those benefits will be qualifying, and they are going to be applied for, and some banks are accepting it and some banks aren't. And it's interesting, some of the larger banks are not. The medium, smaller type banks are accepting that information. And when it comes down to it, we have to put a valid forgiveness application paperwork together for the bank at the end, but they're the ones that are going to peruse this. We should make sure that the forgiveness decision is based on accurate data, but I would keep in touch with the banks so you know what your bank is looking for ahead of time, so you aren't surprised at the tail end and they've got 60 days left to make the decision as to whether it can or can't be forgiven. Also, relative to the applications that were made in the first phase and this phase, we found that a lot of the, and it's a question that's come up quite a bit, the larger banks versus the more local banks. It seems that the regional local banks, boutique banks, have been doing a better job percentage-wise of getting applications in. So a suggestion for people that are looking to apply, for customers looking to apply for this next phase, to look at some of the smaller banks. A little bit of confusion still exists. I don't know if Ivan has any more information on this or not. Initially, we were told multiple applications could result in not being able to receive the SBA approval for the PPP loan. Now we have lenders telling clients, make as many applications as you want. The first one that gets in the system is the one that's accepted. There's been some concerns with membership that I've had the opportunity to talk with as to where do they go? They don't have the banking relationship where they've got somebody that can call up and walk them through the process. In other cases, they've applied at a larger bank and the application's not gone anywhere, so they don't know if they can apply at a smaller bank without having an issue. I'm not sure what the answer is relative to multiple applications. Like I said, the information from some of the banks is don't worry about it. SBA has given them an update. I've not seen that update. I don't know if Ivan has seen it or if anybody listening has seen it. So I would still be selective with who I apply to. Very interesting. I learned yesterday that PayPal is taking applications and actually have turned around some pretty quick applications. So if there's any of our membership that doesn't have a relationship with a bank right now, is looking to put an application in, I'd consider PayPal because it seems like they've worked it through pretty quick. In this case, it was a $100,000 PPP loan. So that may be of benefit to those that are in the CEA membership at this time to avoid having to have those upfront relationships with larger banks. If anybody has questions relative to some banks that they might want to work with, feel free to give myself a call. I'm sure Ivan would offer the same. There are banks that we deal with who have offered to help special clients or relationships we've got, even though they're trying to concentrate on their customers because they have a limited number of resources in order to take these applications in. Questions? I think we covered the bonuses being used for payroll. Related party rent seems to be a big one that keeps popping up, and we've covered that. Is the forgiveness taxable? Ivan's covered that. The question that we do have would be the forgiveness itself being used to cover expenses being forgiven, but the deductions for the expenses paid with forgiven debt is not clarified either. Our position is based on what we're aware of right now in the tax law that supports other areas, that those expenses most likely will not be allowed to be a deduction, but it's something they definitely want to consult their tax advisor for when doing the 2020 calendar or fiscal year end returns to cover this period. So again, stay in touch with your accountants, your external accountants or advisors that you've got. It's very, very important because we're getting information daily and sometimes hourly as to what some of these definitions were intended to be. We also are getting information as to what large pools of people are interpreting. And I would have to believe that SBA would acquiesce on a lot of this as long as we weren't double dipping and we're going with what we feel the spirit of the law is and what we needed to do in order to work through this virus issue that we have right now. I don't know if anybody else has any other questions. Those cover the main topics that I've talked to members about over the last several weeks.
I see one comment pop up. I'll read it. Okay, the comment is that the attendees saw that the SBA is required by the legislation to release final guidelines by April 26th. Have you heard that?
We've been promised final guidelines or clarification several times in this process. So yeah, I have heard that, but I wouldn't hold my breath for it. I mean, that's by this weekend, and we know how long it took them to get the emergency second phase through and out for us. There's also issues that arise on a daily basis that they didn't consider, and we're waiting for clarification on. We're erring on the side of, for example, the biggest concern is when a payment is made as opposed to when it applies to cash versus accrual. So we're saying go with the payment basis, go to the cash basis, keep the records accordingly, maintain the full-time equivalents, maintain 75% of payroll, and utilize the funds that aren't forgiven for payroll purposes as much as possible as well.
Well, I appreciate it, John and Ivan. If there's no other questions, we will wrap this up. I appreciate everyone who's able to attend. And our next webinar is next Wednesday at noon, and the topic is business continuity. So be be watching for that invitation. Just one more question, John, if you're still with us,
Yeah.
and that is, the question is the interest on other loans, such as cars, equipment, is that forgivable?
The wording that we're working under right now is they call it mortgage interest on personal property and real property. So if there's a valid lease on personal property or real property, the information we have is that the interest will be applicable for the forgiveness period as the additional portion over and above the payroll.
Got it. Well, thanks again, John. Thanks again, Ivan, and to all the attendees, thank you. As I said, the next webinar is Wednesday regarding business continuity. Until then, stay safe and have a great weekend. Take care.
Thank you for the opportunity, Tim.